Good evening, good afternoon, good morning, depending on where you are in the world. Welcome to the session of financial statements at the Peterson Institute for International Economics. I'm Nicolas Véron at the Institute, and it's my pleasure to introduce this session today with Professor Huang Yiping and Martin Chorzempa. We'll talk about big tech in Chinese finance. Obviously, China is at the forefront of experimentation and innovation, I should say, certainly practice of having big tech companies such as Alibaba and Tencent going very deep into financial services territory, certainly deeper than their Western counterparts even. So there are also inroads of Western big techs, Amazon, Facebook, Google, Apple, and others into financial services. So China, in a way, is possibly the shape of things to come in other parts of the world, or possibly not, and that's our topic today. Huang Yiping is professor of economics at the National School of Development at Peking University in Beijing. He's certainly one of the most acknowledged and admired observers of the Chinese financial services landscape. He studied at the Zhejiang University of Agriculture in Hangzhou, then in economics at the Renmin University in Beijing. He was for a time a scholar at the Research Center for Rural Development of the State Council in Beijing, and then he went on to complete his PhD at Australian National University, in Canberra, in the 90s. He taught there in Canberra and at Columbia University Graduate School of Business in New York in the late 90s, and then spent a decade in financial services at Citigroup as managing director and chief Asia economist from 2000 to 2009 in Hong Kong. And in 2009, he joined Peking University, where he has been serving since. I should mention also, because it is relevant for our topic, and we have a culture of disclosure at the Peterson Institute, that in August of this year, August 2020, Huang Yiping became an independent non-executive board member of ANT, the financial services sister arm of Alibaba, which has been very much in the media of late. Martin Chorzempa, my colleague at the Peterson Institute, is a scholar of financial services and especially fintech in the Chinese context and internationally. He has worked in Germany, in Berlin, at the Association of German Banks, then at CF40, the China Finance 40 Forum in Beijing, which is where we met first. And the CF40 is one of the leading, perhaps the leading independent think tanks in China, an organization with which the Peterson Institute has many joint projects and partnerships. So it's also a way for us, or an opportunity for me to acknowledge CF40 here. Martin then came back to the US, graduated a master's in public administration in international development at the Harvard Kennedy School, and joined us at the Peterson Institute has been here for a couple of years, and is working on a book on actually a topic very close to our topic today, fintech in China. So that's enough for my introduction. Now over to you, Huang Yiping, and we'll then have the discussion. Yiping.
Thank you, Nicolas. I am now going to share my PowerPoint file, but in the meantime, please let me know if you hear me clearly, because just a minute ago, I received a warning signal saying there was some problem with my microphone.
For now, we hear and see you very well.
Okay, very good. So I'm going to continue. Hopefully, the technology works also tonight. I'm going to take about 10 minutes to cover a bit of on the big tech credit, which basically means the big technology companies, you take advantage of both the big tech platforms and a big data analysis for granting credit to individuals and small medium enterprises. The big technology companies in China started from 2003. And in fact, the Alibaba established its e-commerce platform, Taobao, in June 2003, 1 month after the ending of SARS, the previous pandemic, which hit China in 2003. Some people speculate that that might be the reason why e-commerce surged, because people saw the value of contact-free transactions, online selling. Alongside the establishment of the Taobao, the e-commerce platform, Alibaba also created this mobile payment service, Alipay. And the reason was simple. Once you have a Taobao, and even if you have an agreement to exchange goods, you still need to solve the financing problem. The problem was because people, like on the buy side, on the sell side, they never met before, and they probably will never meet again. So the question is, if the seller should send the product first, or if the buyer should pay the money first. And what Alibaba came up with initially was the so-called guaranteed transaction payment service. But a year later, they created this individual account of Alipay, which now is the largest mobile payment service provider in China. The other also big mobile payment service provider, WeChat Pay, came from slightly different background. They started with the WeChat. WeChat is a social media platform. They started to offer payment services in, I think, during Chinese New Year of 2014, when they introduced this so-called red envelopes. The Chinese tradition is during the Chinese New Year, the elders should give out the red envelopes to the juniors. And so when they introduced this electronic red envelopes, it was kind of like very enthusiastically welcomed and attract lots of users to their system. And in fact, that's the reason why I was attracted to this mobile service payment, and I start to use it. And if you look at the system now, on the left-hand side, you can see they already have like almost around 1 billion users for each. Alipay is a little bit bigger than the WeChat Pay, but they are the two leading service providers. I included a number of charts on the right-hand side. For people who ever traveled to China recently, you would know mobile phone is really becoming a part of our daily lives, and we use it almost for every payment. And in fact, there are a lot of other activities developed. On the one hand, they develop a so-called ecosystem, which basically means you can buy an air ticket, you can book a doctor, and you can arrange a hotel, and so on. We can almost organize all of our daily activities around the mobile payment service, the ecosystem around it. The other dimension of it is on this mobile payment and the big tech platforms, they also start to offer other kind of financial services. For instance, direct sale of insurance goods, the online investment products, and so on. So this is what the map I showed you on this slide. Basically, the Peking University Digital Financial Inclusion Index. The different regions were colored in different colors, from red to orange to yellow to green. Basically shows the level of development, with red the most advanced regions in that year. The key message, I guess, taking away from here is on the left-hand side, this is the map for 2011. Essentially, you had a very small number of regions with relatively developed digital finance in that year, but the majority of the country was very underdeveloped. If you look at the map on the right-hand side, 2018, and you find the difference in the colors of the regions significantly reduced. That basically means the lagging regions catching up very quickly during those 7 years. And this is what I became quite excited. I thought this is what we call financial inclusion. Essentially, what I think the miracle is that today, if you have a smartphone and if you have a mobile signal, wherever you are in China, you can almost enjoy the same kind of financial services. That is a big change, because in the older days, financial services can only be granted or extended by building lots of physical branches of banks. And that can be done, but it's very costly. That's why financial services were underdeveloped, especially in the west part of China and in the rural areas. But this mobile phone is changing the lives of everybody. So this is one biggest part of the story. Now, the specific issue I want to spend a bit time on is what we call the big tech credit. Big tech credit essentially means big technological companies like the companies started WeChat, it's a Tencent, or the company started Taobao, Alibaba. There are also a number of other big technology companies in China. They start to grant loans to individuals and the SMEs by taking advantage of number one, the big tech platforms, and number two, the big data based credit risk analysis. On this slide, I included two charts put together by economists from Bank for International Settlement. On the left-hand side, this is what they call fintech lending. Fintech lending is more like the peer-to-peer lending. We used to have a big peer-to-peer lending sector and surged after 2007. In the following 7-8 years, really surged, and we once had more than 6,000 platforms. But that business model didn't really work. And so by now, I think the number is close to zero. I think 2 weeks ago, I heard from the regulators, we still had 3 left. And these were also planned to exit. So I don't know the exact number today, but the number must be either 0 or 3. It's almost gone now. The more promising story is the chart on the right-hand side. This is what I call big tech credit. And as you can see from the numbers here, China is now the largest big tech lender in this space. And we have 3 big, the new internet banks, like the WeBank, which is affiliated to Tencent. My Bank, which is affiliated to Ant Group or Alibaba, and there's another bank, XW Bank, which is based in Chengdu, out of the west in China. So what is unique about the big tech credit? I think one of the key story about the big tech credit is financial inclusion, because as I said, serving the SMEs, the individuals, are usually difficult because number one, it's difficult to reach them. And number two, it's difficult to assess their credit risks. So Alibaba first created this so-called 310 model, lending model, in 2010. Basically, it means normally it takes somebody within 3 minutes to fill in the application, online application. If approved, the fund is in your account within 1 second. And finally, in this whole process, there is 0 human intervention. That is becoming quite promising now. Today, this business model you can see in many other parts of the world. For instance, Argentina, India, even in the US, we're seeing this model. But as I said, China is the largest big tech credit lender. One key feature of this big tech credit is the contact-free transaction, which was actually quite valuable during COVID-19. And in fact, in May this year, IMF Managing Director invited our institute to jointly host an online discussion like this. And the key purpose was for us to invite the presidents of the 3 new internet banks to explain what they did, even with social distancing and the lockdown policies during COVID-19. These banks continue to serve the individuals and the household. The quantity of it is also quite amazing. Each of the 3 new banks now, like with less than 2,000 employees, but they're able to extend more than 10 million loans each every year. The kind of quantity and the speed is just never seen before in the traditional financial sector. Amazingly, even you look at the quality of the non-performing, the banking assets. For instance, the average non-performing loan ratio for my bank, that is affiliated to Ant Group, is around 1.6%. But for average non-performing loan ratio for commercial banks, SME loans, it's 3.2%. If we're looking at the small loans, like less than 5 million each, the NPL ratio is 5.5%. So they do faster, they do in larger scale, and they do better in terms of asset quality. Just want to spend a minute to explain how it works. The 2 pillars of the so-called the big tech credit. Number 1 is the big tech platform. So like WeChat, like Taobao, you already have a big platform. This big tech platform can serve in 3 ways. Number 1 is taking advantage of the so-called long tail nature to recruit or acquire large number of customers at a very low marginal cost. This is shown by the numbers I explained to you. Alipay has 1.1 billion users, and WeChat Pay already has 900 million users. So the platform, once it's established, you are able to attract a very large number of customers. So customer acquisition is almost done already. The next question is if you can convert them into the customers of your financial services. The second function of big tech platform is once these users are attracted to the platform, they will do something. Whether it's social media or it's e-commerce, they start to leave digital footprint, which will eventually be accumulated into the so-called big data. And the big data can be used for number 1, real-time monitoring of the activities of the potential borrowers, and number 2, to support the fintech credit risk assessment. The third use of the big tech platform is also because everybody borrowing money from the big tech companies are on the system. So you might also be able to use that network as a way of managing repayment, controlling the moral hazard problem. The second pillar of this big tech credit is the so-called big data credit risk assessment. Now, we did a study with IMF economists. This was a working paper we published in September. The one key exercise we did was we used like close to 2 million loan transaction numbers from my bank, and trying to use 2 approaches of credit risk assessment. One is the so-called big data credit risk assessment. The other is the traditional bank use the credit risk assessment. The big data approach basically 2 things. Number 1 is machine learning model, and the number 2 is big data. And the traditional model relies on number 1 scorecard model and the number 2 traditional variables. Given the time constraint, I'm not going to get into it, but just to summarize, on the left-hand side, this curve just represent individual models, and the higher the line, the better the performance of the model. On the right-hand side, it's exactly the same thing, AUC, but it's putting into the numbers. So the key takeaway, without getting into the details, is to tell you is that the big data credit risk assessment model works much better than the traditional approach in terms of predicting default. But this better performance is due to number 1, data advantage, because now you have data two unique kind of data that normally you don't have. Number one is you have real-time data. When you try to decide if you should grant a loan, a commercial bank normally would look at the balance sheet, which is often 3 months or 6 months lagging. But here, you can look at what is happening yesterday and even what is happening today. That certainly helps in predicting more accurately what is going to happen tomorrow. The second data, which is also very, very valuable, is the so-called behavior data. So how you behave on your internet, and I think everybody would agree, financial data may change drastically over time, but the behavior often would stay. There's an old Chinese saying, you can look at a 3-year-old child and you can safely predict his behavior after he grows up. So that's a relatively stable data. And these two kind of unique data helps to improve the performance of the model. The second advantage, of course, is the machine learning model, which can handle large number of data and capture the interactions of different variables. So these are the key reasons why they do better. Now, one thing we also found that you can make a credit risk assessment using big data. And if, for instance, you have central bank credit registry information, we can rely on that information alone to make reliable predictions. If we add big data and add the machine learning model, you can further improve the reliability of the model. But the real revolution is not you can help to improve the results. The real revolution is that most of the Chinese SMEs and individuals do not have sufficient data with the central bank credit registry. They do not have enough collateral assets. However, if we rely on this big data, we accumulate whether on WeChat or whether on Taobao and so on, you can still make a reliable prediction about the default, which means you can open the door for a lot of unbanked individuals and SMEs to serve them financially. That is what I regard as a revolution. Whenever I discuss about this issue, the regulators in China, in international organizations would always point out one thing. They would say, well, look at what they're doing now. It looks okay. Their NPL ratio is lower than the commercial banks. But the question, they're suspicious, is that maybe when the financial cycles turn, this model might no longer be working. What happens if there's an exogenous shock? Now, this is a valid question, and this is something we need to look at very carefully. But there is one thing I like to show you. This is the evolution of the NPL ratio during the past year. As you know, we had one of the biggest shocks in history this year, COVID-19. So you do find, for instance, the 3 months overdue ratio in January, in February, that's the bottom line, was edging up and probably peaked in June. So the COVID-19 had some impact on the asset quality of these new banks. But look at the July, August, and the September numbers, they already start to come down. There are many reasons why this is happening. Maybe because their data is more up to date. Maybe because their loans are smaller in size. Maybe because their loans are also shorter maturity. But whatever the reason, we already start to see the loan quality improving from here. While for the traditional commercial banks, my expectation is that next year, we are going to see a rise of the NPL ratio. So this is just the one preliminary evidence. I'm not going to give a conclusion on this, like to say, definitely this model works better whatsoever. I think this offers one tentative evidence that maybe big tech credit can better survive big shocks. And the last slide I like to show you is, if that happening, if that is working, and we are actually seeing this same practice being extended to the traditional banks. If Alibaba and Tencent can do this, In fact, a lot of other large institutions like the banks, they can also do it. In Zhejiang province, in Guangdong province, they're also trying to integrate the different government sources data and help banks to make credit risk assessment. They've also been very successful, although these exercises are just the starting. So I can see this is a growing business, not just for the big tech credit companies, but also banks can work on it. The big tech companies also collaborating with the banks, jointly extending loans and so on. So my final question is, if this really grows, what does it mean for financial stability or for the macro economy? The starting point here was, you probably heard about the so-called financial accelerator mechanism proposed by former Fed Chairman Bernanke and his co-authors in 1999. Financial accelerator basically means a lot of SME loans are based on fixed assets, collaterals. So that means there's an internal mechanism. If the asset price rise, there will be more credit. And more credit means a faster growth of the economy, more liquidity, which will in turn push up the asset price. So kind of like a virtuous cycle, you're moving in the one direction. On the other hand, if there is a decline in property price, there's a squeeze on the credit, which will further push down the asset price. So the implication, I guess, is if there is a significant financial accelerator mechanism, then a small decline in property price could potentially end up in a big financial crisis or even recession. However, in our case, the big tech credit now relies on data, not on fixed assets. And that means this this financial accelerator mechanism might be weakened or completely removed. What we did here was we trying to estimate an elasticity of the credit with respect to the property prices. So on the left-hand side, what we use is for my bank, the big tech credit. As you can see, 0.055, that number is insignificant. It means big tech credit does not respond to the property price. There's no financial accelerator mechanism here. You look at the numbers in the middle. This is a secured bank credit, collateralized bank credit. And you find that the elasticity is 0.6. Basically means if the property price drops by 10%, credit will be squeezed by 6%. This is what we meant by the financial accelerator mechanism. So that is there with the traditional banks collateralized loans, but it's not there for big tech credit, which I guess alternative suggestion is if that finding is robust, then we might actually say big tech credit could to some extent improve financial stability going forward. But I'm not going to draw this implication. I'll stop here, Nicolas.
Thanks so much, Yiping. We went a bit longer than the usual format for these introductions, but I think it was well worth it given the richness of information that you gave us. Now over to you, Martin.
Thank you. It's always difficult to follow Yiping, who actually kind of, his guidance got me started on China research when I was based at Peking University for a little bit. So you can attribute anything insightful, I'll just say, to his mentorship, and any errors obviously are my own. My remarks are going to focus a little bit on a side of the big tech and finance piece, which wasn't really addressed in the previous discussion, which is why it's so much larger in China than elsewhere. And I think the answer lies to a great extent in political economy, including the recent bombshell of the Ant IPO cancellation. So I'll talk about sort of three factors of the reasons why it's so much larger in China than in places like the United States. The first factor is risk-taking in the face of regulatory uncertainty. Yiping showed us, the beginnings of Alipay. But what's really fascinating to me is in 2000, around the same time that Alipay was going to launch, Jack Ma told his team, if somebody has to go to jail for this, I'm going to go to jail for it, because there was no regulation in the space. It was a total gray zone. But the PBOC, the central bank in China, purposely left no regulation in the space for years to allow it to grow. So there was a little bit of political support there. By contrast, US tech companies seem to be terrified of federal regulators marching into California to ask them to divest their non-financial businesses because of long-standing separation of banking and commerce and the Bank Holding Company Act in the United States, which makes approximating what the Chinese firms would do much riskier, and US tech firms have not taken the risk. The second factor is something Yiping has done a lot of work on, which is financial repression. So in China, until very recently, there was an extreme lack of competition in the financial sector due to state monopolies. Payments were really only available through one provider, which is UnionPay, a government monopoly for card payments. And all the major banks were protected from competition. Their focus was channeling savings into underpriced deposits and serving state companies and the state. That led to a huge very artificial undersupply of financial services waiting to be served, and thus a much larger addressable market than in places like the United States, where there was a lot more coverage and competition in the banking system and in financial services in general. So there was less open space, less room to run for US tech companies in their financial sector. The third, and I think the most decisive factor, though, is a political breakthrough around 2012, because you could have had this financial repression continue if the government didn't allow any of these firms to enter financial services. And I would argue that the risk when you have regulatory uncertainty is only possible to take in China if the political class is either ignorant or supports your innovation. So in 2012, ignorance shifted to support. I think before 2012, the regulators cared very little about things like Alipay and also Tencent Pay. But around this time, growth is declining in China, and the previous growth models are running out of gas. So the premier at the time, head of the official in charge of the economy, says we need to break up the bank monopolies and start. And at that time, there's a flurry of financial licenses given to private firms, and the big tech firms, for all the reasons Yiping gave, were the main beneficiaries. They were most able to capitalize on this new opening to private firms, and that led them to be able to satisfy this artificially held back demand. And Governor Zhou Xiaochuan, the head of the central bank at the time, gave this amazing speech an interview in 2013 that said, we're not going to regulate these firms with the old frameworks that we use for banks and traditional financial institutions. We're going to give them time and space and decide on a regulatory approach later. I don't think any of us could imagine the head of the OCC, the Office of Control of the Currency, or the Federal Reserve, or the Federal Deposit Insurance Corporation, any of the American regulators saying, yeah, we have these laws in the books, but we're just not going to apply them to new companies and not require them to get licenses. I mean, we spent years trying to figure out if you can give a charter to a fintech company that's not quite a bank, so that you just don't have the level of regulatory flexibility and political support in the United States than elsewhere. So where are we now in this political economy? I'll end with this. Since 2016, for many reasons, the pendulum has shifted more towards regulation and control of the financial technology sector, including the big techs. There's been a nationalization of pieces of financial infrastructure that these firms built. But at the same time, regulators were held back in what they could do because these firms had so much political support. It seemed that we had moved to a stable equilibrium where these companies were doing what they call Techfin instead of fintech. They're focused on being kind of a technology provider for the banks, helping banks to deploy capital. But then that's the reason they did that is because you can't really take on state-owned enterprises so directly in the new era due to other changes in China's political economy. I'll end with kind of one comment on the IPO, which is in 2014, Jack Ma did a very similar thing to what he did at the Bund Summit recently, which is he kind of publicly attacked the regulators and the banks. And the result then, because of both this public support and some political wrangling behind the scenes, he neutered rules that would have banned the QR codes that now become so common. That was an amazing result for him, but it also gave him some enemies in the regulators. But then when he tried the same thing in 2020 with the Bund Summit speech, we get an IPO cancellation, and the leadership of China was infuriated by this attack. So now the gloves are off, and there's been a flurry of regulation. I think there's been a big shift in the political economy, and these firms, I think we're probably seeing the end of disruptive financial innovation in China, probably not of financial innovation in general, though. I'll end with that.
Thank you so much. And really lots of food for thought from both presentations. We have plenty of questions. I'll start with one question asked by Stephen Cecchetti, which is about still the scene setting for you, Yiping. Can you remind us of the orders of magnitude? Maybe two questions. One is the banks, my bank, WeBank, within the credit provided by the big tech, because at the beginning, I think a lot of the credit that those platforms offered was not channeled through the bank. So is it the case now that those bank operations channel most of the big tech credit, or is it still a relatively marginal contribution to the credit that goes through those platforms? And a side question from Greg Smith on this: are the banks, my bank and WeBank, subjected to the exact same regulations as other banks, traditional banks? And the other broader question is, how big is big tech credit compared to bank credit in general? And can you give us the order of magnitudes here?
I don't have the exact number here. If you look at the proportion, they're probably just only like a 1-2% of the overall bank's balance sheet or outstanding loans. So they're small, but they're growing. And as I said, they're already the largest market in the world. And the other thing is, most of the big tech credit are small in value compared to the, for instance, SME loans definition by the regulators in China is like less than 10 million yuan is regarded as SME loan. But for instance, for a big tech credit like my bank, the average size of the loan is 30,000 yuan. So the gap is very wide, and to some extent, to a large extent, at the moment, they're still like complementary to each other. They're not competing or overlapping. That's, I think, is very important. But they feel very important, the gap or hole in the traditional financial system, because these people were never like serviced by the traditional banks. At the same time, while the loan value is small, the number of SMEs they serve is like tremendous. Like one bank would be able to serve more than 10 million customers within a year. That's kind of like a revolution. So in terms of the value, it's still very small. And it might be growing over time. The second point is, well, most of these credit is still like extended, for instance, by Ant Group. Ant Group has some kind of microcredit license. I think some big tech credit companies, they're also doing the same. So they're not exactly the banks, but more like online microcredit companies. So this is why now there's some confusion whether or not they should be brought under the same kind of regulation. However, the three banks I mentioned, the WeBank, the MyBank, and the XW Bank, these are fully licensed banks. So in theory, they are regulated by the same set of rules. There's one difference, however. These new banks do not have the regular deposit account, because the regulation at the moment still doesn't allow distance opening of the banking account, which means if you want to open a bank account, you have to like meet the staff and sign the form by yourself, which is not possible because all these three banks don't have any the branches across the country. So this is why they rely more on, for instance, asset issuing in the securities market and through other channels and so on. They don't rely on the bank deposits. But the general set of rules are the same because they are also commercial banks.
And in terms of, say, in Ant, the microcredit non-bank piece versus the bank licensed piece, how does it compare in terms of overall size at this point?
I think at the moment, my bank is not exactly a part of Ant.
Oh, okay.
My bank is set up by Ant jointly with many others. I forgot the exact share, but the original rule was the banking regulator issued a license on the condition that Ant would form this new bank together with a number of others, like you have 3-4 shareholders. And I think the maximum stake was 30%. It's the same for WeBank and for XW Bank. In terms of the asset size, I don't have the exact number here, but I think probably the microcredit portfolio of the Ant Group is bigger than the MyBank at the moment.
I have a follow-up question on this from Nick Lardy at the Institute. Is it still the case that MyBank and others are restricted in their geographic business scope?
They're not restricted geographically because they're online bank and they can basically serve clients everywhere. I think there's the question, the geographical restriction is probably more applicable to the microcredit license. There's a new discussion that maybe this business will be restricted to where the license is issued. If I understand it correctly, Martin can correct me. I think quite a number of these licenses were issued in Chongqing, in the west of China, because the former mayor, Huang Yiping, was quite supportive of this new kind of business. He hated P2P, but he thought this online microcredit was good. So quite a number of companies had a license from there. Originally, once you have the microcredit license, you start to do your business across the country. But the risk now is if that new discussion of the regulation is actually implemented, then it will have geographic implications for their business.
Martin?
Yeah, I've read the new regulations and they say that essentially you have to have a very large amount of capital and submit yourself to national level regulation, because previously you had sort of the issue that Yiping mentioned before. I don't think that the Chongqing example is particularly regulatory arbitrage compared to some others, but you could essentially shop around and find a lenient jurisdiction that was local and then have a national lending business. And there's no way that the local regulator can adequately supervise that business. So the new rules are kind of saying you have to be large enough and regulated at a national level if you want to do national level business. Those rules are, that part of it might actually entrench Ant's position because it's one of the few that actually has the capital and capability to comply with those rules. But another side of it is capital rules, which have kind of blown up the funding model, which was previously in existence. So the microcredit loans that Ant provides, about 2.1 trillion renminbi at the moment outstanding, at least at the time of the IPO. And 98% of that was came from outside institutions. They only kept about 2% on the balance sheet. And the new rules that are proposed but not final would require them to put 15 times the 2% they have now. They'd have to have 30% put up that money. I actually think that that comes from a bit of a misunderstanding of regulators of the nature of this business, because I think the credit risk is in the banks. So it really, you should focus on whether the banks are adequately, doing risk assessments themselves. I don't necessarily see, I don't see why you want to turn something that was very tech-enabled lending business, where they're more like a service provider, into making them hold capital as if they were the banks.
I have a couple of questions about, probably inevitably, about the digital currency projects of the People's Bank of China. Question from Lyric Hale on e-RMB, and Robert Donor. How do you look at the digital RMB project versus those tech players? Is it the way to compete with them? Is it motivated by concerns about the competition that tech players provide versus banks? And also, another question from Lyric Hale, which is, why doesn't the kind of services that you presented stimulate more consumptions? The Chinese economy still has too low consumption compared to with other indicators. Why isn't there more impact of this credit provision by big tech in terms of increased consumption? Yiping.
Well, I think the central bank digital currency, what we call DCEP, digital currency electronic payment, which means it's a retail digital currency. It's a very modest first step. According to PBOC, DCEP only replaces a substitute for currency in circulation, not a deposit in the banks. They don't pay interest on it. And the issuance is through the two-layer system. Central bank issue the DCEP to authorize the institutions. The authorized institutions would face directly the public. And there's been some experiment at the moment. The relation with the big tech player and the mobile payment, my sense is it happens at two levels. Number one, if DCEP is an electronic payment, then it's inevitably there will be some kind of a competition, right? You can use Alipay, you can use WeChat Pay, but you can also use DCEP for payment. So to some extent, I think that competition is inevitable. And in fact, it will also create some new competitors. For instance, the authorized institutions would include Tencent, Alibaba, but also the big banks like ICBC, Bank of China, and so on. They would also start to create their own EP wallet, which means the DCEP can put into their wallet. Then they will have a new payment system. The question there, I think, is, well, number one, just the payment would probably not be attractive enough. As I mentioned earlier, we are stuck with addicted to our mobile payment, partly because of the ecosystem built around it, because we organize our lives around this mobile payment. The question now is, can these new institutions also develop a similar kind of ecosystem to make them quite attractive? So I think competition is inevitable. But the second thing also to look at is Alipay and WeChat Pay can still exist because you can put electronic RMB into the Alipay account or wallet. You can also put the DCEP into the wallet. So Alipay will continue to exist. The question is, are they going to use the same electronic money like they're using at the moment, or are they going to expand on the DCEP in their wallet, which will be more attractive? We don't know. But I think, so my answer to the question about the mobile payment is, number one, definitely there will be some competition and the new competitors coming into the place. But the second is, that certainly doesn't mean we're going to drive out WeChat Pay or Alipay. It only means you might change the content in your wallet. But the question about your future business is really up to your competitiveness. Whether your user experience, your comprehensive services is still up to date. That is a challenge for all the tech players.
Martin, I'll beg you to be succinct on this because I want to move on then to the international implications of all this.
Yeah, I essentially agree with everything Yiping just said about DCEP. I would add that PBOC has been very clear that they're going to let this ecosystem grow through market forces, not through fiat. Because one could imagine a way where you could bootstrap and kind of compete against Alipay and Tencent Pay would be to say, we're going to mandate that everyone takes some PBOC provided wallet or something like that, in the same way that you have to accept cash if it's offered to you. And they're saying they're not going to do that. So I think that's positive.
I want to move on to what that means for the rest of the world. We have a number of questions. We have questions about privacy regulation from Miguel Angel Civilotti, from Michele Savini, Zangradi. How would this translate to other places where there are privacy regulations of the kind of, for example, the general data protection regulation, GDPR, in the European Union? And we have a question from Britt Hecht on how those services are received in other emerging markets like Latin America. Are they welcomed? Are they considered a foreign invasion? How does that play out? And also to frame the same kind of views, but seen from China, a question from Julian Callow. How do you relate this debate about big tech credit with the current emphasis on dual circulation? And how would you which for non-China watchers, of course, is the current language on China's economic strategy of domestic market and international openness. How do you see dual circulation interacting with the international ambitions of big tech, and ultimately what will be the international impact of these Chinese innovations?
Maybe I'll take the last question first about the dual circulation, which basically means we're going to focus more on domestic demand, but also domestic supply. On the supply side, I think the question is, how do we support innovation? There, funding to SMEs really is critical. As we already know, SME is probably not fairly treated in the Chinese economy for quite some time, but probably on the margin, the services they receive have been improving. That's why on the margin, the economy is still becoming more efficient over time. Now, the question why the SME funding is becoming a bigger problem than ever before is because the private sector, which mainly consists of SMEs, now accounted for more than 60% of GDP, 70% of the innovation, the patents. This really explains why if we can't find ways to support SMEs, there's no future for the Chinese economy, no growth, no employment, and no innovation. In that regard, I think a big tech credit offers one viable business model to support SMEs. Now, this is not the entire solution. There are many other things we need to do, but this offers one solution to support the SMEs. I think this is quite valuable in that regard. In relation to the international implications, I do think the first thing I want to say, China's fintech or digital finance is probably ahead of some other countries, but mainly in the area of financial inclusion, providing services to the underserved individuals and SMEs, whether it's in terms of payment, in terms of credit, in terms of investment, and in terms of insurance. I think this is the breakthrough we are seeing in China. Now, this is exactly where I think the experiences can be transferred or can be shared with many other developing countries. So give you one example. Alibaba is already working with BeCash in Bangladesh, with True Money in Thailand, and with Paytm in India. The reason is because once you have a system of more than 1 billion customers, the kind of the basic infrastructure is there, and you have the know-how technology. So you move to another country to collaborate with a local partner. It's reasonably easy to just export the infrastructure and the technological framework. But because finance is quite sensitive, so Alibaba's approach is to take a minority share in that joint venture, but they help to set up the technical aspect of that system, and it's been working pretty well. I think helping the poor in Bangladesh, for instance, I mentioned that before. In the older days, kids from the countryside going to the cities to work, but they did not have any way of sending their money back to their village. The most common way is to stand aside of the highway asking a truck driver to take the money back to their village. That is a very risky and high cost. Now, with the BeCash, this is a very simple, like the SMS message system. Now you have a money transferring system and improve the lives of everybody. Alibaba's job is improving on that system, exporting what we have here. That is tremendously helpful. So I think there are lots of rooms to work on it, but we also need to be careful. Financial services are always politically sensitive in many other areas. So we need a cooperation, and China can export some businesses, but we should keep it private sector to private sector, and we should probably keep it low profile. That's my take. So
I can take on the DCEP and privacy question. it's very hard to get a grasp on exactly what kind of anonymity people will have and what kind of privacy under the DCEP system. The previous director of the central bank's Digital Currency Research Institute said that the PBOC would control the ledger, which means that they know everybody's wallet address and how much is in their wallet and every single transaction that occurs, and also has the identity data there. So essentially they can see every transaction of every individual in real time. And that is a far greater government access to data than under any existing payment system today, which usually requires, the government gets access only if there's like a suspicious activity report or there's some criminal investigation. This would be a real-time thing. I think that kind of model would never fly in other countries, maybe in authoritarian countries that would like to monitor their financial system, but definitely not in Europe and the US. But really all countries now are struggling with this problem because cash is totally anonymous, well, as close to it as you can get. But I don't think that if you invented cash today, it would be anonymous because it would fly against anti-money laundering rules. So all of the Fed, the ECB, and many other central banks are all talking about we need some sort of anti-money laundering controls, some government access to data, but we want to make it very anonymous, provide as much privacy as possible. And I don't think anybody's really come up with a good way of balancing those two considerations now. And all eyes are going to be on how China does it as being kind of the first.
I have two follow-up questions on these international dimensions. One is from Bhavesh Sangam, who notes that the joint ventures in Pakistan, India, Bangladesh are, as you said, useful for financial inclusion, but not very profitable. He mentions Paytm in India. So the question is, what will regulatory overhang mean for the health of these firms? And do you see them being sustained as businesses, which echoes, in a way, the questions that had been asked by Britt on Latin America and whether Chinese service providers, even if they provide that kind of inclusions, will be welcomed, given political sensitivities. And there's another question by Julian Callow, which is about RMB internationalization. So you answered in terms of the digital RMB, which is basically not aimed at internationalization or wholesale transactions, but how does the growth and importance of big tech finance fit in with the desire to create the RMB internationalization? So this, again, I think plays to the interactions that you mentioned, Yiping, between the tech aspect, the platform aspect, and the financial intermediation aspect of those solutions. Yiping.
Well, I don't have specific knowledge about the operation, the financial performance of these joint ventures in other countries. So I can't comment why they're not making money and how they can make money. But just looking at the experience of the Chinese big tech credit players, you will find that really takes some time. You needed to build a large, big tech platform. Now, as I said, the marginal cost of recruiting new customers is low and even almost to zero. But the building that big tech platform is very costly. At the moment, the big tech creditors, the lenders I mentioned earlier on, the three banks, the interest rate they're charging are still higher than the traditional commercial banks. That's a fact. But I still think that's a good step forward because you at least have the access for these potential borrowers. So I think we needed to develop the business. You also needed to develop the business by improving the credit risk assessment. If we are not able to accurately predict the default, then you have to charge a very, very high interest rate because you have to cover your risk. But if our approach is improving over time, then the potential cost can be reduced. So I think the profitability will come with increases in the scale of your business, the efficiency of your business, and the skills that you accumulate over time. Hopefully, financial inclusion is what I regard as commercially viable business. So only if they're commercially viable, they can continue over time. Now, the question about the internationalization, I mean, I think Martin is right. digital currency is a useful way for support some international use of it, but itself is not, doesn't mean anything about the internationalization. So it is still a domestic DCEP, but hopefully for the future cross-border settlement of investment and trade, this new form of the Chinese RMB might be useful because they're faster, they're safer, they're low cost in settling the transactions. I think that would probably be useful. Connecting the DCEP with the big tech players, I think one possible strategy, that is not an official strategy yet, but I would certainly suggest and propose. I think China will need to open up and to go out more and more in the coming years, especially these big tech lenders. They're doing pretty well, but they need to stay as a private sector initiative. I would strongly advise against the government taking action supporting these going overseas. That would probably only counterproductive. But I think with the DCEP, with the private sector initiative, we can go a long way in helping the others. This, I mean, China is doing, as you probably know, One Belt and One Road initiative, trying to build infrastructure for other countries. But for most of these countries, they also need to improve financial inclusion. If financial services at the grassroots cannot be improved, it's harder to develop the economy. Big tech company finance offered one possible solution, and I think that might be more useful to share.
Unfortunately, we're out of time, and I would like to have another hour to continue because we have a number of questions we didn't answer, questions from Richard Portis and Greg Smith in particular on the domestic competition from credit card offerings from relationship banks, also different segments of lending to SOEs in particular going forward. Lots of things to map, but that will be for another session. I want to give very heartfelt thanks to Huang Yiping, also because it's very late in the day for you, so we appreciate your time availability in the late evening, and to my colleague Martin Chorzempa for what I thought was an extremely enlightening conversation and really demonstrates that we have to spend more time on Chinese finance in this series and more generally in the way we look at the world these days. Thanks so much. The next session will be on December 9 with the first speaker being Thomas Philippon on whether finance is doing a good job or not at serving the economy based on his well-known and well-acknowledged research. And in the meantime, have a very good rest of your week. And for those in the US,